Welcome. Thank you all very much indeed for joining us today. I'm very pleased to see that we have a lot of managers from across the US following this, as well as others from different countries. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in London. We now have two publications of particular relevance to the US market. The ESG report, which tracks the impact of ESG on the global fund industry, and FSI, a publication we just launched this autumn, specifically for US managers looking for help with their fund structuring when they go offshore or come to Europe. With me on the panel today, I have Beth Greiber, who's Managing Director, ESG and Sustainability Initiatives at Mackay Shields, which, as I'm sure you all know, is a major money manager based in New York. We have Philip Pericki, who's Head of Business Development in the US with Jersey Finance. We have Sean Wilkie, who's Partner and Head of Strategic Growth at Greyline, which is a regulatory consulting firm with offices across the US and in London. And we have Quentin Wikotowicz. Sorry, Quentin, I'm not sure I got that pronunciation exactly right for your last name, who's the partner at Ethos Invest, which is a private equity fund house based in London, at Quentin's in the US. And I'm very pleased that we have Caroline McGee, who's just stepped in and taken the place of Bill Gordon. She's responsible for ESG at the US law firm KS Law, King and Spalding in Atlanta. And I'd like to thank Jersey Finance very much indeed for sponsoring this event today. Now I'm going to give a very short presentation. Hopefully this will come to life and it won't freeze. Okay, that's happening. It is freezing at the moment. It finally jumps into life at long last. So I'm going to give a short presentation for about 5 to 10 minutes, and then we are going to get into a panel discussion. You are all very welcome to join in. If you would like to join in, just use the Q&A button at the bottom of the screen. We'll try and take the odd question as we go along, and assuming we get questions, which I hope we will then also reserve some time at the end of the discussion for a formal session for questions, and we'll be finished by 1 o'clock Eastern time. Anyway, so let's get started. So where are we in the evolution of ESG? Institutions supporting the UN's PRI, which, as I'm sure you all know, is where it all started, less than 20 years ago, by the way, have over 20 trillion. This is institutional investors. We're talking about the pension funds of this world, have over $70 trillion in assets between them. The investment houses have also signed up for the UN's PRI as well, and they have 100 trillion. That's obviously the BlackRocks, the Fidelities of this world, and all of those guys. And here's a particular figure I particularly like to quote, which is from Bloomberg Intelligence. They came out with a forecast at the beginning of this year that assets globally in ESG will reach $53 trillion by the year 2025. That's over a third of the entire globe's assets, which is an extraordinary figure. And this is a particular quote that I like very much from the person who is responsible for a global report that PwC put out on ESG at the end of last year, Olivier Carré. He said that ESG is, quote, a once-in-a-century opportunity. So what's happening in the US, which is the large part of the focus of our discussion today? What's interesting perhaps to know as we begin on the US is to say that pretty much all the investing activity that I've seen in my career has all started in the US and spread out to the rest of the world, whether that be hedge funds, private equity, ETFs, mutual funds, which in this country we used to call unit trusts, et cetera, et cetera, et cetera. Normally emanates in the US and then goes global from there. ESG is the other way around. It started in the rest of the world and now it's come to the US. It started particularly with the North European pension funds, the Canadian pension funds, the Australian pension funds, the superannuation funds, as many of them are down there. And it slowly started at the top of the food chain with the investors, and it's sort of worked its way down into the managers. And the US in the last few years has really been rapidly catching up with what's been going on in the rest of the world. And here's a figure from the SIF Foundation that said at the end of last year, US ESG assets had just gone through the $17 trillion mark, which they say is a 42% increase since 2018. I'll be very interested to see what the figure is at the end of this year. I'm sure it will be quite a lot higher than that. And of course, we now have the new administration in Washington, not so new anymore, but when shortly after the Biden administration got started, he came out with this goal of turning all power generation in the US, making it carbon neutral by the year 2035, and making the entire nation carbon neutral by the year 2050. I mean, these goals are there obviously to slip, but at least you've got the target, and that will generate hopefully a lot of activity in its wake. And where are we in the evolution, as I've already asked? That's the $1 million or the $1 trillion question. Cerilli Associates, which I'm sure you all know, is I think it's a Boston-based consulting firm, estimate that $68 trillion will be passed to children from parents in the next 25 years. I think that's global, but obviously predominantly, probably largely in the US. It's an extraordinary figure, and by far the world's biggest generational transfer, given what's happened to real estate prices, the stock market. You have it over the last few years. By far the biggest generational transfer of wealth is about to, or begun already to take place. And the real estate company in the US says that there are already 618,000 millennial millionaires in the US. That figure is only going to go up very substantially indeed in the next few years. So where are we? Again, I asked in the evolution, where is ESG going? That's what we're going to get into in the panel discussion in a minute. Will ESG separate out into more defined investment areas? That's something I would like to see. And what could go wrong? Being a bit of a skeptic by nature, as I perhaps am, I always like to think of what could go wrong. And on that basis, I'm going to bring up the thorny subject of greenwashing, which, with two, I think, superb quotes from on this side of the Atlantic. One, Marcus Beckstrom is one of the most successful ESG managers in the world. His fund was up 43% last year, and it really is a proper ESG fund. He came out with this very good quote: greenwashing is a real problem. Without some way to police the way the concept is used, meaning ESG, it runs the risk of being reduced to a marketing exercise. And that is the danger. How much of those massive figures I was talking about a few minutes ago are all to do with a bit of a marketing sleight of hand, if that's the right way of putting it. And this quote I really do like. May not resonate as much in the States as it does over here, because I don't think anybody in their right mind would even touch eating horse meat in the US. We don't in the UK either, but it does get eaten to a small extent in some continental European countries. And there was a scandal here in the UK a few years ago when some of that got into our lasagna. And so Molly Scott Cato, a professor of green economics, came up with this quote: when people found there was horse meat rather than beef in their lasagna, there was an outcry. But when the equivalent happens in the financial sector, as it has for years, customers don't even have the right to know. And that is something that I think just has to be tackled for obvious reasons. So questions for the panel we're about to get into in a second is, what industry support mechanisms need to be developed for ESG to really flourish as a proper entity, without that marketing sleight of hand I was talking about, without that greenwashing, etc. Will or should ESG have a major impact on the fund industry's own business practices? That's something I will come back to in a few minutes. I got some strong opinions on that. How much does the growth of ESG depend upon investment performance? I think that's a very interesting question. And should ESG be broken out into more specific and easy to define investment areas? These are all areas we're going to talk about in a second. But before we do, the last thing I want to mention before we get to the panel is that we're about to take, I said earlier on, we're first and foremost a research firm and a media house, major piece of research before the end of this year, hopefully starting early to mid-November, with big institutional investors around the world. Some help, some friends I have who work with those entities, and we're going to ask. We're going to particularly ask in these three areas and perhaps some others, is how much do institutions allocate to ESG for performance, in other words, risk-adjusted returns typically, and how much is it for altruistic reasons? Just reading some research recently, I noticed there's wildly different answers to that. Morgan Stanley did some research, I think last year, that said it was mainly for risk-adjusted returns, and BNP Paribas said their research said exactly the opposite. That might say more about their client bases, I don't know, but we will be asking institutions a lot of questions on that. But the most important area, we think, by far of this research is to really get into the different components that make up the different strategies in ESG and try and make some sense of them, because they're all over the place right now. We want to see what institutions want to allocate to companies that are involved, for example, in pollution prevention, promoting renewable energy, reducing energy consumption, resource depletion, carbon emissions, nature preservation. That's coming up in the rails quickly. It's big in Jersey, by the way, Philip, as I'm sure you know, nature in terms of what you've been doing in Jersey, and try and find out what it is that the institution, I don't think that question has ever been asked before, so we're going to ask it. And we also thought we would ask these investors what they think of the various agencies that do the ratings on ESG. So those are some examples: the MSCIs, the Bloombergs, the Thomson Reuters, the Moody's, the S&Ps, and the Fitches, etc. Because they're all so different, and it's a bit frustrating. And unusually for us, we are going to do a big consultation exercise with fund managers on the questionnaire. If anyone would like to be included in that, please get in touch with me or Tamara Sims or Samantha Taylor, our researcher, and we will include you on the iterations of the questionnaire that we'll be starting on in a few weeks before we take it to the investors. And we want to make this as much as an industry-wide effort as we possibly can. So that's enough from me. I'm now going to stop sharing screen, and hopefully the panel will come up. Hooray, they have, fantastic. And let's get into the discussion. Right, the first question I want to ask you all, please, anyone can pick it up who wants to, is how do you think ESG investing will develop in the US? Beth, you mentioned munis in our prep call the other day. I don't know whether you want to take this first. Do you think, when you're looking at it from your perspective, where do you think the next couple of years are going to be going?
I think it only becomes more prominent in time, but I can get to munis in a minute, but I do think one of the keys to advancement of ESG is developing a little bit of a more common nomenclature and understanding what people are talking about. In Europe, the SFDR defined sustainability, or at least attempted to. In the US, you've got investors thinking of ESG in some instances as a risk mitigation tool, maybe an integrated way to look at things. You've got investors thinking about it as a value or impact tool, and they're both calling it ESG. So I think, you know, that's kind of something that we need to flush through as we move forward. But it will be interesting. Data remains an enormous problem in thinking through ESG and ESG integration. And one of the things that we did talk about in our prep session the other day was the space of munis. Munis is an enormous market in the US, both for institutional and retail investors. And while there have been several data vendors who've attempted to start looking at the market, there's 50,000 plus CUSIPs in that market, tons of issuers to cover. So they sit back and they say, gosh, where do we even start here? How do we look at this? How do we think about it from a financial risk perspective? From an impact perspective, there's all sorts of different ways you can look at use of proceeds. You can look at a variety of different things, but it's a market that is ripe, if you will, for impact. but there's no consistent data set. There's no way of really looking at it holistically across managers and across investors. And even thinking more about the muni market, many of you have probably read in the press, climate-related risks as they pertain to municipal bonds. I think there's a lot to come there in terms of market development and how that moves forward, but yet still it's a challenge mapping out what the risk is and how it applies to your investment. So, I can let others chime in, ask questions.
Well, Quinton, you're on the investment side. What do you think? I know you work in the Middle East a lot, and your firm's based in London, but you're US based. Am I right in saying? How do you? Yes. So you've got a good international perspective on this.
Yeah, I mean, I think the growth of ESG is very interesting. I think that we work a lot in the Sharia compliance space, and we're dealing with some of the same definitional database challenges. How do you actually compare across Sharia compliant products? For example, how do you even define what Sharia compliant even means? In our prep call, we were talking a bit about this. In the Sharia compliance space, it's generally been defined by just two basic criteria, which is capital structure. You can't take certain kinds of debt, or there are thresholds that are set. And secondly, sector. You're not supposed to invest in certain kinds of sectors based on Islamic principles. But beyond that, if you take the principles of Islam, just if you took the principles and intent behind ESG and go beyond the letter of the law or of international agreements to what is the ultimate purpose behind that, there's probably a range of different ways in which we would engage in both Sharia compliance and ESG. I think that, right now people are really struggling with how do we develop our policies? How do we develop our shareholder agreements? How do we develop our metrics and reporting back transparently to our LPs? But I think the next evolution is going to be thinking, as Beth said, much more holistically, but purposefully about what it means to do ESG. What's the intention? Again, one of my criticisms in the Sharia compliance space, particularly outside the United States, is that people tend to look at the letter of the law, so to speak, as opposed to the intent and objective. And I think one of the criticisms is rightfully that there tends, as a result, to be what I guess you could call it Sharia washing in a way, the analogous to greenwashing, that people are just kind of doing enough to check the box. But if you look at other activities related to governance, supply chains, how they treat their human capital internally to the company, they're not really adhering to it. So I mean, there are definitely parallels in both those kinds of ethical systems of investment.
Caroline, you're in Atlanta, am I right in saying? So it'd be interesting your perspective from there. We often get people from New York and occasionally Chicago or San Francisco. How does it look different from where you are, from perhaps some of the other, I don't mean to say this disrespectfully to the home of the Braves and whatever, but with ESG from where you are, as opposed to the Northeast or the West Coast?
No, it's interesting because our work is global. So a lot of our work in ESG is cross office and across different countries, because there's so much. We're trying to understand how the language is working in different parts of the world, because this is a major issue, coming up with a common language. Something that may be of interest, CalPERS, the big California pension fund, recently announced a partnership with Carlyle Group and some other private equity to develop a standardized set of ESG metrics. They've called it, I want to get this right, the ESG Data Convergence Project. Because they are taking it into their own hands. There's frustration with, we don't have shared sense of metrics. We don't have, we all have commitments, and we're all perceiving upcoming regulatory pressure, but we aren't sure what the rules are. So they are getting together to try to come up with some rules and language. So we're just going to be monitoring that to see what emerges as metrics there. Because there's so many different conversations happening, we're going to have to come to some sort of shared conclusions at some point, or it's very difficult to communicate across these different metric sets. We are seeing a lot of pointing to the task force on climate-related financial disclosures, which I'm sure everybody else has seen as well. As far as the SFDR in the EU, it does not look at this moment like those will be adopted wholesale in the United States. We're still figuring out what metrics will apply. And my understanding of the SFDR is that there's still some details that need to be pinned down in the SFDR as well, and what's going to be required of companies going forward, which is understandable. It's going to take a little bit of time to get this right, and it is useful to see the forward progress. But we're doing a lot of monitoring right now and seeing where places like the pension funds who really want to get active, and private equity who are starting, they want some rules, they want to know what's going on. What are they going to come up with on their own? And maybe some of what they come up with can be adopted into a broader spectrum.
Thank you. I'm glad you mentioned that, because that's exactly where I wanted to go next. And maybe we'll come to you, Sean, and after you, Philip, on the subject of ESG regulation. As Caroline just mentioned, she mentioned the SFDR, and Beth mentioned it too. What's going to happen? You're the expert probably on regulation on the panel, Sean. What's going to happen to ESG regulation in the US? And for those in the audience that aren't aware of this, SFDR is this absolute monster that we have over here in Europe, in the European Union, I should say, which UK is no longer part of. And level 1 of the SFDR came in March. At the time, we thought level 2, which is the difficult bit, the first bit is the easy bit, would be coming in January next year. That has been postponed till July next year. And I would take any size bet anyone would want to make. It's going to get postponed again. And it could, worst case scenario, be postponed out of existence. The EU is very good at just postponing things out of existence. It never formally cancels anything. It just keeps putting them back and back and back. And I know the regulators here in the UK, and I'm certain in the US as well, are watching this thing very closely, because what they've bitten off here is just so unbelievably complex. Sean, so what do you think, given what we not in the UK, because we're not going through it, but what the European Union is going to go through, where do you think regulation in the US is going to go over the next couple of years?
Yeah, I think here in the US, certainly with the coronation of the Biden administration, we've seen an increased appetite for regulating ESG, at least at some level. We've seen countless public statements from the SEC chair, commissioners, proposed rules, executive orders from the president himself. So I think it's relatively safe bet that we'll see some form of regulation. That being said, I think unlike what we're seeing in the EU, I think it'll be largely focused on public company disclosures as opposed to anything specifically aimed at the investment management space. At least in theory, the SEC already has the framework to regulate investment advisors simply by applying the false and misleading standard to ESG-related representations. And to this extent, I think we'll see regulation through enforcement and exam activity. Rather than pure rulemaking. That's really been the SEC's, it's been common practice for the SEC for years, given the fact that it's the path of least resistance to effective change. We've already seen an uptick in exam inquiries into ESG practices, where the staff is asking managers to really prove that they're making good on those representations and promises. So now ESG isn't just a front office issue, it's also a compliance issue. So like all things compliance, if you can't evidence something, it's as if you've never even done it. So I think managers are having to go the extra step of putting in place, monitoring programs so that they can demonstrate that, they're making good on those promises. And to piggyback off Caroline's point, it's not only the SEC that's asking these questions, it's the institutional allocators as well, which I think are equally as likely to really dictate policy, disclosure obligations, and just industry common practices as the regulators.
Yeah. Philip, do you want to make any comments on regulation, or because and also I want to ask you about developing industry support mechanisms for ESG. You've got any comments on regulation, or do you want to go on developing industry support mechanisms?
No, well, I won't speak to the regulation specifically, but to take a step back, if you will, and it's something that Beth mentioned right at the very beginning. ESG means sort of different things to different people. And as a result, I think governments increasingly are trying to give greater framework or form to what these things mean. We've talked quite a bit about the SFDR. That's probably the best.
You've just
example of this, but in fact, it illustrates, I think, a really important problem, and that is if you have, I think it illustrates this important problem, which is, does the jurisdictions, the industry have the ability to execute on the demands of these regulations, or deliver what the regulators want in out of the industry? And if I look at, I'll take Jersey as an example, which I'm obviously standing here to representing the jurisdiction, but the ability to sort of work between industry, government, and the regulator to arrive at a place where you're ultimately delivering what investors want to see. And I think that that requires sort of a nimble working environment. So my point on the regulation is, it isn't just creating regulation and letting it sit there and people can't deliver what's needed. It's actually finding something that really works, that industry is able to support. And I guess from a jurisdictional perspective, that starts dividing jurisdictions into those that actually have the substance and the capabilities to deliver that, and those that don't. And that, I think, is going to be a very interesting thing to watch evolve over the next few years. Okay.
And does anyone want to mention regulation? We've got a lot of other areas we want to get into, but before we do that, does anyone else want to say something about regulation? If not, what I want to do is get into something that is a challenging question for you all, or some of you to have a go at, is how can we really develop industry mechanisms? It was interesting, Caroline mentioned what CalPERS is doing, which is great, because interesting, I was just looking at the questions that are coming in. Someone's actually asked the question, which is probably, I don't know whether they asked it before or after you mentioned that. What would it take to get large data providers to get together and establish some common ground rules? And what happens if they do not do that? That's the $1 trillion, $1 million question. That's the ultimate question, isn't it? Because at the moment, everyone's going their own way. You can't even get, I was talking about the research we're about to do, you can't even, I was looking at how the different providers break things down in the E space, let alone the S space or the G space. Nothing is comparable. It's all over the place. Everyone does their own thing. And it's very frustrating, I would have thought, if you were an investor trying to establish benchmarks and comparability. Is there an answer? Maybe if there isn't one, I don't know. Anyone want to take that one on?
Well, I have a thought on, we're looking at who's really pressuring industry to come up with response. And one of the places that we're seeing a lot of pressure is the insurance industry, because from an insurance perspective, a physical risk perspective, an exposure perspective, they're paying close attention, particularly around environment, but there's also social and government exposures that are possible for businesses. And I don't know if you saw the AXA put out recently, they call it the Future Risks Report of 2021. And cyber risk is high on that list, and then climate and environment are extremely high on that worry list, understandably. But something that caught our attention was the CEO of AXA was talking about insurance companies. They have power in terms of their investments. They have a proxy voice in that regard. But then what he mentioned was where insurance has a lot of power is in underwriting and what we will and won't insure. That's where they can have immediate impact.
Good point.
And so we think if there's that kind of pressure coming from insurance, that's the type of pressure that could get businesses and government to kind of get together and figure out how are we going to address the rules so that we are building ourselves and our businesses in a way that we continue to be insurable. So that's one of the pressures. Pension funds in the United States is another one, and pension plans in different states, because some may express interest in divestment, others like CalPERS come up with other approaches, and that's a lot of power. That's a lot of money there. And then we're looking at state action. I know we were backing away a little from regulatory here. In the US, we tend to kind of focus a lot on the federal regulation, but state regulation matters as well. And for players that are playing in different markets across state lines and global lines, a state regulation like New York Department of Financial Services is really putting pressure. They call it guidance on their governed their covered institutions on responding to and putting plans in place and putting staff in place to assess climate-related risk from a financial perspective. So players in the New York financial services space that are also operating elsewhere, they're going to structure their behavior to hit the New York Department of Financial Services requirements. So we're seeing pockets of activity that actually could have broader reach than you might imagine from their charters, I guess, because they're not government regulation or full national regulation.
Right.
And Caroline, if I can even, you've got the, as you mentioned, New York Department of Financial Services, I was going to mention that as well, but the Fed too has this climate supervision committee to look about how to deal with systematic risks posed by physical climate change across the banking sector. So then that brings the question, are there going to be climate stress tests across the banking sector? What implications does that have? How does it roll down? So not to beat the regulatory, madness to death, but it's coming fast and furious.
I think the short answer on stress tests is yes. I don't know when, but it seems like that's where the energy is. And that also could help give a shared framework. If we see what those stress tests looks like, then other industries can kind of structure around the content of those stress tests to the extent they translate. Sorry, I just got excited about that. Stress test.
No, that's what we want.
Actually, Simon, I don't know if there's anything, there's a number of, you could just look at the evolution of the alternatives industry as analogous to something, a very similar process. I don't know anything that's evolving at such a fast rate that isn't messy. So
no, sure.
We're in that sort of figuring out what works phase.
Right.
But to Caroline's point, the biggest players are going to drive what they need.
Right. I'm going to move. Sorry, go on, Karen. Go on, Beth. Sorry.
I was just going to say, to go back to your initial question, though, is there going to be mass data convergence? I wonder if you
just some
consider
standards. It doesn't have to be convergence, just some common standards.
Yeah, and I think back to Carolyn's point, unless someone's pushing a common set of standards, it would be great for companies to come together and do it. I would agree. You need the driving force behind it. I don't know that there's going to be a mass convergence. You look at Moody's, S&P, and Fitch, and they all have different ways. They will disagree on the credit rating of something kind of perhaps similar to how Sustainalytics, MSCI, ISS, or any of the other ones might. But I think that there's at least a closer correlation when you start looking at things from the credit rating lens versus the ESG lens. And again, this all goes back to values versus value or risk mitigation, because some of the data providers look at it from a values perspective. What kind of positive impact are you making? And then other ones still look at it from a financial materiality or financial risk perspective.
And I would actually pose the question, is uniformity a good thing? I mean, I would argue that it's not, given the fact that, maybe from an administrative standpoint to say, yeah, this is what ESG means. You're talking with LPs, they understand it. Yeah, but if you're looking for the end game, I think this potentially waters down, the effect of ESG. And it certainly politicizes the issues when you're trying to define these things and you have different opinions worldwide.
That's really interesting because one of the things I've been thinking about is just to play devil's advocate. When we get into all this shared nomenclature and shared regulatory frameworks and metrics and measurements and proving and transparency, et cetera, to some extent, you start moving away from the purpose of what you're doing, i.e. impacting ESG and doing good for the world, and you focus on just measuring everything to hit benchmarks and check marks, irrespective of whether or not it means something significant for your industry. It sort of reminds me, in a previous life, I did a lot of work with non-governmental organizations, and we kept hearing the same thing, which is they felt like they spent like 80% of their time either writing grant proposals or reporting back, and only 20% of the time doing good for the world. So I've always been a little bit concerned. I heard from one VC fund manager who was linked to a celebrity, and that celebrity explicitly wanted to stay out of this space because They didn't want to get caught up in this conversation. They just really were energized about doing good things for the planet and for preventing climate change in their particular case.
Okay, that's exactly why we have these discussions, because we get more of the free-wielding, let's let it roll approach. When we talk to you Yanks in Europe, it has to be all defined and categorized, and I suppose that's why we still live in a world with different countries in. Can I move on to a topic that I feel particularly strongly about, and this is me sort of biting the hand that feeds me. So I'm about to criticize fund managers and subscribers that we have in different places, but I get very exercised, I suppose maybe the right way of putting it, about seeing some fund managers. By the way, I'm going to exclude, I don't know enough about the US situation, so I'm going to, this is a UK example, although many of the firms are the same firms in the US and in the UK. But I'm going to confine this, what I'm about to say, to the UK, so not to offend anybody in the US following this. But in the UK, we've had an awful lot of fund managers basically do as I say rather than as I do. We've had, I mean, Goldman Sachs Asset Management said at the beginning of last year they weren't going to invest in any corporates anymore unless there was at least one female on the board. But then you look at the fund industry, at least the UK fund industry, that would exclude, not that Goldman Sachs wants to invest in any other fund managers, but that would exclude nearly half the fund managers in London. And here in the UK, just recently, meaning 18 months, 2 years ago, the regulator, the FCA, required 2 more independents on fund boards, an ideal opportunity for them to freshen up their boards, bring in more diverse people from different racial backgrounds, maybe more women, however you want to define diversity. Did they do that? No, they didn't. They went to all their old buddies and, you know, in the city, the people that I like to hang out with. And basically they got a lot of people back that used probably retired to come back as their independent directors. And so there hasn't been, at least yet, at least here, much of an attempt or significant attempt to really embrace the spirit of ESG. Well, they're all putting out ESG funds, but they haven't changed the culture in their businesses really at all, insofar as you can measure it. If you look at, you can see who's on the board by going to public documents. That hasn't changed, at least yet. It probably will, but it hasn't yet. And there's various other ways one can make the same point. Sean and his firm and my firm did some research earlier this year. I think the US was slightly better than the UK. We actually looked at business practices by fund managers in the UK and the US and whether they are adopting ESG practices. It is beginning, but it is, Sean, I only remember the figures, somewhat in a minority. Not many of them are asking their service providers yet to adopt ESG practices either. That may come, but at the moment they're all jumping on the bandwagon to raise assets, but they're not doing anything to change the culture or make their institutions more diverse. And in Europe, we have a very peripatetic European fund industry where basically if you want to have a meeting with somebody, you have to jump on an aeroplane and fly off there because everything is in a different part of Europe, which is slightly different in the US. So I'm going to get off my hobby horse and say, do you think in order to embrace ESG properly, the fund management industry, whether it's in Europe, the UK, or the US, has to become, at least get into the spirit of it rather than get into the spirit of the law rather than just the letter of the law? Does anyone want to take, Beth, you're kind of nodding to that. Do you agree with that? I mean, you work for a money manager. I don't know whether that anything I've just said applies to you, or Quinton, does that apply to you? You're different, much different size firms. But anyway, over to you. Do you want to answer
Quinton,
that,
do you
Beth?
want to take it first? Or?
Yeah, I mean, I can talk to it from our experience and perspective, not just in the ESG space, but you can imagine what this is like in the Islamic finance sector in terms of trying to provide diversity of governance, for example, and gender inclusion is a particularly challenging thing in our sector. You know, I think a lot of this is about process. I mean, Phil was saying it's messy, right? And I think as long as the policies are in place and the intentions in place, and you have purposeful plans in place to try to create diversity and to apply these standards, then I think that you're moving in the right direction. I think at this point in time for the industry, it's really all about are you moving in the right direction? Not are you doing it, or are you not doing it, but do you have a plan of improvement? So even if, for example, in the context of London, it's all old male buddies that have been in the industry forever and you're not getting the diversity of perspective, is there at least a concrete, actionable plan in place to make improvements over time? I think sometimes a lot of firms get probably criticized for past behavior and not necessarily for the future they're trying to direct themselves to, which can be a bit deflating. But I think it is really, it comes down to intent and putting in place the steps you would need to get the direction that you want to get.
Would you agree with that?
I mean,
Beth?
I think absolutely. I think it's about kind of like where we are with ESG. It's a journey. I think there are target points along the way. There's a goal today, which might shift tomorrow, but it's a journey. And I think you need to have, especially today, concrete evidence that you have embarked on the journey, that you're giving it thorough consideration. I know, just speaking for Mackay, we had a new president join about a year ago at this point, and she's very passionate about DE&I. We've developed a variety of different committees. We're working on enhancing hiring practices. We're working on a whole host of other things. And it's not that we hadn't thought about it before, but we didn't necessarily have as many concrete policies or practices, or maybe we could do better. So a lot of it is just moving forward on this journey and showing the forward trajectory, and not to get off the DE&I path, but you can liken it to thinking about transitioning, if you will, from a climate change perspective, from a dirty polluter transitioning to cleaner energy provider or a different part of its business. It's a very similar long journey that I don't think ever stops. I think you keep striving to do better.
And Simon,
Can I follow? Oh, sorry.
Oh, sorry.
Ahead,
No,
Phil.
go ahead. Well, I was just going to, Quentin, you made a point that direction of travel, how important that is. And Simon, I'm going to ask you just to sort of think back to 2019. And if I recall, at a conference that you were speaking at, you brought up the notion that in the United States, even in 2019, ESG was still largely thought of in the context of portfolios themselves. So the assets that were being held. Fast forward 2 years, we're talking now about inculcating this idea, value-driven idea, through the entire organizations themselves, no longer just within the concept of the portfolio companies. So that shows you the direction of travel, even over, it's been a bonkers 24 months, but okay. 24 months.
I'll just to challenge you all, and I want to come back to you on some other aspect in a minute about domiciliation for I think it's Thomson Reuters. Somebody does a D&I index. I think it's Thomson Reuters. Somebody does it once a year. How many, the top 100, you know how many asset managers or money managers are in that top 100? One out of 100. So, and it's not like the other firms are very different. It's, there's the KPMGs of this world. It's, if BlackRock is in it, but nobody else is. If BlackRock's in it, if KPMG's in it, then why couldn't it be other money managers too? But again, that's historical. Philip, I'm going to move on the impact of ESG on industry practices and move away from the diversity thing and ask you about domiciliation. How do you think, wearing your Jersey hat perhaps, how do you think ESG will impact fund domiciliation, and what's Jersey doing in this area?
Well, I don't think there's any reason to think it won't. If it's going to, if these lenses that we're looking at decision making are cutting across all aspects of service providers, the managers themselves, what they're doing, it's going to also be directed at where you're structuring your fund vehicles. So choosing vehicle or choosing jurisdictions that are equally aligned with steps going in a let's call it the right direction, or a direction of travel that's aligned with what investors are looking for from the managers, from the fund investments, et cetera. So it stands to reason that jurisdictions will start separating those that are able to deliver what investors want and those that are going to struggle. And I think ultimately that comes down to an infrastructure issue. And by infrastructure, I really mean like human infrastructure, or Quinton's phrase, human capital in the jurisdiction. Can they deliver? Are they able to do this? And is government aligned? So to take, to take Jersey's example, you have the sort of Jersey for Good project. You have Jersey for a Wired to World project, which is a rewilding project around the world, which is done in conjunction with the Durrell organization, which if anyone here knows, it's the Jersey Zoo. So these efforts, industry, government, and the regulator are actually trying to walk the walk, or walk the talk, pardon me. They're really trying to align themselves. And I think over time, again, this is an evolution, that becomes clearer and clearer. And I do think that will be part of the analysis that investors make when they make investment decisions.
And as Phil knows, that fund managers make jurisdictional decisions because of that expertise, and we're a good case in point. I mean, our last fund is actually, domiciled in Jersey specifically because of what Phil just mentioned, sort of the growing expertise, not just in ESG space, but also in the Sharia compliance space. So those kinds of, value signals and the human expertise and the people. And it's really amazing engaging with individuals in Jersey, because it just seems I keep finding expert after expert and substance after substance. So it definitely makes a huge difference from the fund manager side of things.
So Quinton, when you were going out shopping for a domicile, did you go around looking at different jurisdictions and see that Jersey had more of the expertise you were looking for than some others? Is that how you ended up there?
I mean, it's a balance between practicality and then do people have the expertise for, certain kinds of fund structures and what you're trying to actually achieve. Now, in our particular case, the Sharia compliance side of the value-based component was really heavily influenced by Islamic finance, not just ESG. So in that case, it made sense. But there was also the practicality that Jersey was just a really welcoming, easy to navigate, experienced jurisdiction for us. So you put those two together, and it was a very enticing location.
I couldn't have said that better. I absolutely couldn't have said that better. Thank you, Quinton.
You're welcome.
I don't know how much you're being paid for that, but you did a very good job there, Quinton. I'm sure they'll be very pleased to hear that in Jersey. I said I'd try and keep some time available for questions at the end. I'm just looking at the questions we've got. I've already asked one of them. Perhaps we should go to the two that remain here. We have half touched on one of them. Why don't regulators do more to stamp out greenwashing? Can they stamp out greenwashing, or is that comes back to the previous discussions of the way that this diversity that we have how can it be done basically without regulators getting very handy? Perhaps Sean, you'd be a good person to ask that too.
I don't know that there's a great answer to that, right? I mean, it's almost how you define greenwashing and what that actually means. I mean, I think for any of these ESG related representations, you really have to flesh out what it means to the manager, what it means to LPs, and whether there isn't this, I don't know, commonality and understanding. Right. I mean, I think that's what it comes down to. What your LPs think they're getting need to match up with what they're actually getting. And I mean, yeah, I think that's how you look at it. I think that's why this is such a thorny issue, why it's so hard to regulate, and why it kind of has to be assessed on an individual case-by-case basis in order to have effective regulation and policing.
Right. Anybody else want to talk about greenwashing and what can be done to stamp it out? Or
I actually have a question maybe that might spark something, but one of the challenges that was raised in the recent SEC risk alert was in some of the firms that they observed from an ESG perspective, and the oversight was that compliance individuals were not well versed enough to be able to adequately ensure controls on the ESG processes. I wonder too, because of the rapid way that this market has evolved, if that then also lies with the regulators. Do they have adequate knowledge to stamp out greenwashing if they
Good
could
question.
even do it?
Yeah, good question. That's the problem. They don't, probably.
Yeah, and there was actually a speech by one of the one of the commissioners not long ago, I can't remember which one, who readily admitted the SEC doesn't necessarily have the expertise on staff, right? They're a collection of lawyers and accountants, and they're going to set policy on environmental, social, or governance matters. It doesn't necessarily match up. I mean, I think the industry also has a problem in terms of, investment professionals aren't necessarily well-versed in ESG either. So, I mean, there's certainly a discrepancy and a disconnect, let alone compliance professionals, which, there are a variety of things that they're, tasked with policing that they don't necessarily have the expertise. So it's a problem across the board.
Yeah.
I think this plays a little bit into this last question that's posted about how much does the environment actually benefit, which sort of goes to Quentin's point of, is this, to the extent attention is being paid to environment and climate, are our choices making any difference or not? And there's definitely some data recently that indicate that we're not in a trajectory to make a meaningful climate impact right now. But I think from a legal perspective, we're seeing a lot of effort in trying to put the structures in place. I think Quentin and Beth both mentioned this. Putting structures in place, and I suppose I can't speak to everybody's motivation, but in conversations, it sounds like there's an interest in creating structures and iterative procedures to really try to get to impact versus just trying to hit wickets. And we're interested in, we're seeing a big rise, of course, in a market of third-party reviewers and reporters that are supposed to help us manage the knowledge, the ESG information, and measure that and understand it. So we're really interested in how do we build relationships with those third parties? How do we get value out of the reports? How do we interrogate the reports to make sure they're meaningful and teach leadership to do the same within their enterprises, not just to trust on its face like a glossy brochure. But at this moment, I think it probably is safe to say we're not seeing a lot of true environmental impact or perhaps social impact as well. But how can we help create the structures and the questioning processes to get us to impact and have us continue to test? And my last thought on this is I hear the phrase ESG story a lot, and it gives me a lot of anxiety. We're not interested in encouraging the telling of ESG stories. We're interested in the actual processes and steps and measurements and the freedom to go back and reassess and make change. If your goals are impact, to kind of get to those impactful goals and be able to narrate that process versus telling a coherent story coming out of the gate and then getting too attached to that story, even if it's not connected to facts on the ground.
I should read out that question that Caroline has just been referring to, and I'd love for other members of the panel to comment on it as well. How much does the environment actually benefit from the boom in ESG investing? And whoever wrote this is obviously a subscriber because he or she says there was an article, which there was in last month's ESG report, our publication, saying its impact is negligible compared to the scale of the environmental crisis. The point of that article, it's been a while since I read it or contributed to writing it, is that it's so minor, the incremental value on saving the planet, if that's the right way of putting it, in comparison with the issues that we have to face. It's been great, ESG for raising assets, it's been a great bandwagon for asset raising from managers of different shapes and sizes, from ETFs to hedge funds to private equity to mutual funds to the whole kit and caboodle. But at the end of the day, looking at the other end of the telescope, how much good is it really doing? Is it going to have to be a regulatory thing that stops, the world turning to floods everywhere or fires everywhere or whatever? Anyone, we've only got minutes, just a very few minutes left. There's huge, ridiculous quick to spend all day talking about this. Does anyone want to chip in for as a sort of finale on that?
I would just add one point to that, which is that, you know, we think of these things as snapshots, and perhaps that's what's being alluded to in the question, but you have to consider these things as a compounding effect over time. So yes, we're here today, but if you look at that as it evolves over the next, a year from now, where will we be in 24 months, or et cetera, that compounding effect is not negligible. And that, of course, it's in the future, so we're not measuring it yet today. But if you parallel that against your asset prediction, Simon, I think that you can start extrapolating out where you think we're going to go.
Okay.
You know, it's interesting because to me, it also brings to mind the difference between maybe using ESG lenses as risk mitigation and to signal your values versus SDG-based investment. So the UN Sustainable Development Goals, where there are huge investment opportunities in areas like health and well-being and decarbonization. Yeah. And typically it's not thought of as a risk mitigation strategy. It's just a great way to make money. And it aligns with the values of trying to save the planet.
Well, we never got to the question. I got 2 or 3 more questions we never even got to. We'll save it for another day. Is how much does the growth of ESG depend upon performance risk-adjusted returns as opposed to saving the planet and stuff like that? But our time is almost. Beth, you've got about. Can you answer that question in 1.5 minutes? A massive question like that. What is the? How do you balance that out? I mean, that's an impossible question to put to you for so little time.
No, I mean, I think Philip said it right in that it's a journey. It's all a journey. So what we do today will impact how the impact rolls down tomorrow. I don't know that it happens without regulation, unfortunately. I do believe that regulation will be required because different companies, different individuals have different goals. Some of them are to save the planet. Some of them are to maximize short-term profit. It's that concept almost of managing for all stakeholders versus immediate shareholders. I do think we are making progress. Having a conversation in and of itself is progress. We weren't having this conversation a while back. So yes, I think we are making an impact. I just think that you need to start looking at it through more lenses over more time. Nothing happens overnight.
Thank you. Well, listen, I think this has been an absolutely excellent panel. Thank you all for your contributions. Thank you to Jersey Finance again for sponsoring this event today. I want to remind everyone what I said at the beginning, that we are going to embark on this research in hopefully starting mid to late November. And anyone who'd like to have a look at the various drafts of the questionnaires that we're going to be putting out, please do get in touch with either myself or one of my colleagues I was mentioning earlier. We'd love to include you in that. And we really would like to get the input of investors on what I mentioned earlier on. So thank you all very much indeed for joining us today, wherever you are in the world. And hopefully we'll see you again before too long. Thanks again. Have a good afternoon or evening or wherever you may be, even morning in some cases. Okay, bye-bye, everybody.
Bye-bye.
Thanks.